Hey, it's Darren with Arbitrage Trade. It is time for Deep Dive with Daniel. He said he's over in Bangkok, the world traveler this for the week, for the month. How long are you there, sir?
It's till the end of the week.
Till the
Medical
end of the week.
tourism.
Okay. And then moving right medical tourism. All right. I won't ask why
Yep.
you're there then. We'll move right along on that. We the blog you came up with this week, be prepared. It'll take a minute for the title. Here we go. It is leveraging game theory and gambling strategies for smarter trading and investing. I need a break now. Okay, so
I
we're
should
ready to go.
probably start writing for a news publication, huh?
No, because the title would be way too big and they'll say shorten it, millennial, for us, please.
No, like it would work in like Time magazine or something. I feel like they have long
I,
titles.
I suppose they have to use smaller font to get it all in at the top of the page. All right, so we're going to break this down. You bring a lot of phrases and terminology this week in the world of gambling and game theory, and we're not talking about like Call of Duty or Fortnite here. We're talking about stocks, right? But I guess the same strategies could be used. I don't know, but we're going to get into some specific strategies that you brought that I've never heard of before. So it takes someone that's been in investing in wealth management role, I think, to know these theories. But and by the way, I enjoy a good game of Texas Hold'em. That may be why I like stocks in general, and I do play it. I play it a couple of times a week. So let's start off. Well, why don't you just give an overview of what you brought this week, and then we'll get into the specifics of each one.
Yeah, so game theory was actually kind of originally like invented around gambling. So famously the Kelly criterion, which is the one that talks about how much you should kind of like invest per, in gambling sense per hand, but investing it's like per trade. And more or less how much you should invest based on how much you think you're going to win so you don't go broke in the end. So
Right?
a lot of this is like, kind of this theory and whatnot, but is actually used by a lot of traders in a more like practical, less abstract sense, just to not go broke. Because
Yeah.
if you cannot go broke and you can make a little money on the majority of your trades, then you make money as a trader.
Well, and that sounds a lot like tournament poker, because you can't reach back in your pocket. You basically have to use that because if you're going up against somebody who it's all about what is your pot size versus what their pot size is. So you can't go broke or you're out of the tournament. I mean, that's
Mhm.
sort of what happens in poker. And I saw a lot of correlations between poker basically and this, which I've always put those two together anyway, because it is gambling um, in general. But you said the Kelly Clarkson. Is that what you said?
Kelly criterion.
Oh,
Yeah.
okay.
Yeah, so
A
so
diff
what inspired this blog post was I was listening to a podcast about a guy named Ed Thorpe, if you know who that is. He is the
Mhm.
original quantitative hedge fund guy. Like
I'm
he
sure I
started the
love him.
first oh
Mhm.
yeah, first quantitative hedge fund guy. I think he started in the 70s, I want to say maybe.
Wait a minute,
But
we talked about him before, right? I think?
no, that was Jim Simons.
True,
Who
true.
so this guy was before Jim, and the way this guy started, he was also a mathematics professor, but he got his start by going to Vegas and winning a bunch of money. And
There
pretty
you
much
go.
he did that first, then the mob tried to kill him, and he was like, I don't want to deal with any of that smoke. And he goes, where's the biggest casino in the world? And he goes, stock market. And so, of
There
course,
you go.
being a math professor.
So he was the kind of the original OG, stock mathematician or so. He started all the
Yeah,
hedge
yeah. No,
fund.
no, he started the first quantitative hedge fund, the first one using, like true math, if you will.
There you go. I will not have a picture of him in my room and framed or anything like that. But
No, that's in my room, Darren. Come on.
it probably is on your ceiling. Anyway, I won't get into that. So you also brought up the Nash equilibrium. So is this about
Hmm.
Nashville or what? What's this?
No, no. So this has to do when there is when buyers and sellers are kind of at the same level in the market.
Right.
And this helps people understand where there would be, an equilibrium if they could identify in the market, and which helps people understand if things are like overbought or oversold. So you could think of like your traditional RSI indicator tries to help you figure out the Nash equilibrium if things are currently overbought, oversold, or supposedly where they should be. Um,
Right.
that of course would believe or would you would have to believe in an efficient market theory, which if you're applying game theory to investing means that you don't believe in efficient market theory to a degree,
Mm.
you know?
Well, yeah, there's where there's a buyer, there's a seller, and it's like in theory, it would have to there would have to be a gap for the price to move one way or another, but that's just not the
Mhm.
way it works.
No.
It just doesn't.
Nope, not at all.
Not at all. Right. Still watch those level twos. All right, so you've talked about the Nash equilibrium, the Kelly criterion. You also mentioned this sounds kind of morbid, but the prisoner's dilemma. So it's a life or death thing. I mean, what is this about?
No, so Prisoner's Dilemma is that famous Stanford experiment that essentially showed that even when individuals could cooperate for a better whole interest, that they
Mhm.
only ever cooperate for their own best self-interest. And this one I had never really thought to apply to markets before. I thought it was the most interesting because the effect here is that when markets start to sell off, it would actually be in everyone's best interest not to sell, because if no one sold, then the market wouldn't move down. But instead, everyone panic sells in their own best interest to, continue to capture whatever gains they had up until that point, and then which just creates a proceeding cascading
So this sounds.
selling effect,
Oh,
in which case
yeah.
the entire market starts to move down.
Yeah, or in this case, the algos throw it down. But what it sounds like to me is a political thing. I mean, if you think about it, if both sides would work together, then it would be better for the country. But I digress. We'll move on.
That's insanely accurate and just made
Yes,
me more sad.
that's why you're not in the U.S. anymore. I'm just kidding. That's not why.
Dude, I still have a U.S. passport. I still pay U.S. taxes.
That's right.
It's not like I moved to Puerto Rico where like I pay less taxes and I can't vote.
There's time. There's still time. I need to save up some more. I need some seeding money to go do that.
Yeah.
So, um, I mean, it seems to me though there is kind of the hedge funds hedge, so they're hedging against something that is the other way. So that by definition is your prisoner's dilemma, right? I mean, but because they're both going against two different things, or they're just protecting against two different things, so that there's an upside and a downside. And I mean, is that not in general the prisoner's dilemma, or am I missing something here?
Kinda. I think more of that like hedging aspect is using the risk of ruin. So really just trying to like evaluate like what would ruin them either in that position or their portfolio as a whole. Right. So
Mm,
they're trying to just make sure that they don't lose money essentially, right? And so funny enough, Ed Thorpe's fund was the first fund to run what's considered a market neutral hedge fund, right? So they're
mhm.
essentially shorting as much as they are long, with the
Right,
idea that
right.
you know, kind of it'll still go up incrementally without like the volatility.
Gotcha. I was gonna say because you have to hedge one way or another to make money. You can't just be exactly
Hmm.
equal. But it just seems to me that the hedge funds nowadays really specialize in shorting and of course trying to bankrupt 100-year-old companies. But I digress again. Let's move on. So you talked about there was three different terms: expected value, risk of ruin, and martingale strategy. I think you said. So
Hmm.
your expected value is what you think you're gonna win or lose?
Yeah, per bet, and this helps
Okay.
you.
Poker
make
again.
sure
Go ahead.
you yep, and make sure you understand how much to bet per, that hand, if you will, right? Because if you're have a 60% chance of, in your mind winning this bet versus 80%, it kind of changes your Kelly criterion input of how much you would bet.
But if I apply poker here, if you're, it's the bluff. I mean, so if you apply more than what the value is of your hand, you might get the other person to fold. So if I'm shorting something, right, and I'm trying to take it down in price, and I actually really short it, like AMC has been, then I'm trying to get people to fold, and I'm trying to get them to sell so that I make more money. So I if it feels like that's a lot like poker to me.
Yeah, but then for something like that, you have to take into consideration, the next one, the risk of ruin,
Right,
because
right.
if you applied too much leverage and then it doesn't go your way, and then you ruin yourself, then your guaranteed value is zero.
I would be so sad if that happened with some certain hedge funds around here. You might even get called in for, say, regulation issues and stuff, like they're trying to do now. Which, if you've watched any of my daily things, you know any chance I get a chance to put that up, it's up. So
Did
let's
you
move
cover
on.
the Carl Icahn like illegally
That was
leveraging his
today,
book for
actually.
personal stuff?
I think it was in today's or yesterday's three things.
Was it?
So I didn't miss that at all.
I saw that and I was like, dude, come on, you're telling me like some lawyer was like, hey, bro, don't do that. Or like, if apparently the issue was like, you can do it, which I find a bit ludicrous, but like, he just didn't disclose it for like 4 years of doing it. I was like,
Hmm.
dude, what?
He was all, in fact, there were a lot of pictures with him and, oh, heck, what's the GameStop guy, Ryan Cohen? Is that right?
Mm.
So there was a lot of pictures of them two talking to each other, and as all part of that buildup of the GameStop thing, and maybe they were going to be together. And heck, in the long run, maybe they were. Who knows? Um, but anyway, we won't get into what they do with that to try to get people to sell or buy, because that would be illegal. So let's go on to the martingale strategy. And this is a lot like what I see maybe at the craps table a lot. So if I lose, then I'm going to double down the next time to win it back. Is that to get even? Is that what it is?
Yeah, Darren, this is actually something you're an expert at. Is that this is essentially dollar cost averaging down.
By exactly half.
As
I mean,
yeah, exactly. So as the gambling theory on this is that when you lose, you double your next bet to make up the previous bet that you had. And so this applies to trading when you are continuously entering a position, whether it's going presumably down to dollar cost average down to get what your entry point is less, so that when it does go up,
yep.
you make more money quicker.
Just as
I know
an
my
example.
roommate has done that with Alibaba and is
Ah,
in financial ruin in that position.
yes. But when China revives, he's ready.
Yeah,
um,
I actually saw something the other
it's about
day.
time, right? Time.
We,
Yep.
we no, we might cover it, I think, in our after the bell segment, but that like the outflows this year from China have been like absolutely insane. And I forget what the Chinese government did something to backstop um like the downturn of the market. And it was just like it was going so poorly. I was like, oh wow, that's pretty bad.
Well, I see a lot of leaders that are, speaking out against China, but then they're shaking their hands in the back rooms and creating deals because they know that their countries have a lot of money invested in, speaking of averaging down, into Chinese stocks. So it'll be fun to see what happens there, especially with the unwind still going, even though they're hiding it well right now from the yen. We'll see. I mean, again, like I told you earlier, I've got popcorn and Coke ready to watch the rest of the year, but um, the whole average down thing, like you were saying, so I guess I'll just use this as maybe an example of maybe somebody having AMC that at one point was 100 and something dollars a share, and now it's down to like $15 a share. So I would say that that's a good example of someone that keeps doing that. Not me or anything, but just, maybe some people like me. So I'll
Yeah, yeah, yeah. Poor
so when you
guys.
that's right. So when you get down to the base of this, I would say it's about psychology and strategy mixed all together with all of this, which again is what the stock market's all about. It's funny because I remember some, let's just say OG guys that have been in the market, some of the older guys that come on CNBC that they always pull up and they say it's not a game. The stock market is not a game. Why do these kids come in here? They're talking about, these new investors. They come in here and treat it like a game. It's like, what the? It is a game too. In fact, you say gambling in almost everything that goes on. This is, so I'm just so tired of that. These older guys. See, even I can have something against the OGs because
No, I
it's
mean, I
ridiculous.
I think that the market has become more a function of gambling than it has ever been.
Mm,
And like I just feel like it's almost impossible to deny that now. Like, yeah, I think when Warren Buffett started Berkshire Hathaway, there was like some legitimate investing going on, and like now, and like unless you're buying an ETF, like it's pretty hard to argue that like it's you know none of these quantitative hedge funds actually add any market value. Sure, maybe some liquidity, but like
mhm.
how long is Renaissance Technologies in a trade for? I think the average is like
Oh,
a day and a half.
yeah,
Like, it's like, come on, like what are you doing?
exactly. Anyway, so that's really good. I like the way it was. This whole thing was talk about something else I really like to do, which is play poker. But it is, as I've always thought, the 3 or 4, I guess we're up to 4 years now that I started becoming interested more in the stock market. It is a game, and it's just a matter of how you can play it. And it's still house odds, and what I mean house odds, I mean the funds and their algorithms. But what's great is like the algorithm that we have here at Arbitrage Trade can match wits, if not be better. So it's a great way to outwit the house, if you will. So it's fun to watch that every day. And since we have the tools here to look at it and see. By the way, I do pick of the days Monday through Wednesday.
Yeah,
Little plug, little plug on
a
your
lot
show. So
of these things we talked about today are kind of inherently built in the arbitrage
right.
trade assist, right? So,
Yep.
if you're somebody who doesn't want to think about all these different little things and do the math in a spreadsheet, we have the tools to help
Or
with
you
that.
can't just sit there and watch it. You're not a swing trader. That's not your job. So, I mean, unless, and a lot of these things, like even when I put my pick of the days in, I mean, they're done. That move is done in one day. So you're not going to sit there and have time to just constantly look at your phone. I mean, your wife or your girlfriend is tired of that already. So stop doing that. Let somebody else do the work for you and maybe increase your love life. Hey, there's a new line for us. No, I'm just kidding. All right. Well, I appreciate you bringing this in. You got anything else about this or no?
Nope.
All right. Appreciate you bringing this. This is kind of fun. We made something that seemed kind of definitions and
I
terminology, but
I was worried it
we
was
made
going to
it
be a
fun.
bit boring. Yeah,
We can make anything fun. All right. Like watching grass grow. All right. I'll see you next week, Daniel. Thanks for coming by.
sounds good, Darren.